What's up, everybody? Welcome to the TDB channel, where I challenge you to think, dream, and believe in yourself with a focus on personal finance. So what I'd like to discuss today is the stock market as a whole and how our young generation is really scared to get involved in the market. And I want to demystify some of these myths and really go through and explain what exactly the market is and why we shouldn't be scared of it. So before we get started, please take a minute, hit that subscribe button, hit the notification bell, and make sure to hit the like button for me. So when we look at the stock market, it's something that causes a lot of fear in a lot of individuals, especially our younger millennial generation. And this is something we really do need to look at and make them comfortable and get them involved in the stock market. So if you think of a ship in this case, what we're looking at here is the ship going across on the waterline without having any issues at all. It's floating along, there's no issues, but there could be a hole down below and we would have no idea that it was there. And that is exactly what's going on with the stock market in these young generations that are coming up through the world. What they're thinking is they're going along on their ship, they're not looking below the waterline, they're not understanding that there could be a hole that could sink them in the future. All they're seeing is, well, I'm doing well, I've got a nice apartment, I've got a nice house, look at this fancy Tesla I just bought. But what they're not understanding is this is short-term success, and they need to be looking down way in the horizon and understanding some of the long-term gains. Now, I'm not saying there's anything wrong with having a nice apartment or a nice house or driving that fancy Tesla or buying some stuff that you really want. That's certainly part of life and what we need to do. But what we don't want is to not look in the future. By looking in the future, we're going to ensure that we actually have that same level of quality life that we have right now well into the future and not have to worry about anything moving forward. But if we're scared to think and we're only living in the moment and we're not looking towards retirement, and retirement's going to be a large piece of that's going to be the stock market, then we're going to be setting ourselves up for failure. Now, I think some of the concern with the stock market is that it's a complicated place. There's tons of moving parts. I don't know what's the difference between this stock market ticker or what's going on with this rate of return, or do I look at the 1-year rate or the 5-year rate of return? And everyone just gets complicated and they just shut off and they're just like, never mind, I'm just not going to invest. I'm just going to focus on right here and right now. And so what I want to do right now is I want to go ahead and work through what exactly the stock market is and break it down so we're not nearly as overwhelmed by the different choices that are there. There are a lot, but if we take our time and go through it, we certainly can figure out what's going on. And so in this video, I just want to make sure that we kind of understand, give us a baseline level for what the stock market is. And so what I want us to do now is actually want to think of the stock market as a supermarket. So we all go to the grocery to get our food. We have to, right? It's something that we do. When you first walk into a new grocery store, you're probably overwhelmed by what's going on. So that same feeling is there for the stock market. But what happens is after time, as you learn a little bit more about the layout of that supermarket, you start to get comfortable. And before you know it, you know where every piece is through that grocery store and exactly what you like to buy. Now, there could be things in there that you know are over here, but you're not really focused on buying them. And the stock market's no different. There's tons of companies that are going on and are being traded on the stock market. And that's something that's going to be there, but you don't necessarily have to pay attention to those. It's just noise, just like when you're going into the grocery store. And what else we can do with that grocery store is we can think about how there are positive things that you could buy that are healthy for you in the grocery, and there's also negative junk food things that you could buy. Now, every once in a while you might whet your appetite and say, yep, I'm going to go for those donuts, some of those junky food things, but you might know that you need to buy, blueberries, for example, and those are going to be healthy, good long-term things for you. And the same is true with the stock market. You could be trying to find the next Amazon or Tesla and hop on a bunch of different single stocks, or you could look at the healthy option and you could be buying mutual funds, some safe companies that are going to be good long-term positive things in your portfolio. And then the other piece that you can think of with the supermarket here, if we look at that blueberry example that's good for you, is the blueberries, they're going to vary depending on when you buy them throughout the year. And that's gonna, a lot of times for blueberries, that's gonna depend on, are they in season in your area? Are they being flown in? Lots of factors go into the supermarket prices. Well, the same thing's true for the stock market. It's what's going on with the company. How well are they performing? How many people are buying that stock? What's some external factors that are going on? Whether it's in the world, in the political arena, there's a lot of things that can influence the price of the stock. And so they fluctuate throughout the year, just as the blueberries do, just as the stocks do. And the key here is that you just recognize that they're going to go up and you're comfortable with that. If you know that going in, that's going to make some of the fear that you're having about buying a stock, or the fear that, oh, well, if I buy it right now at $50, how do I know it's not going to go down to 30 and then I missed out? Or if I buy it here at 50, it's going to go up to 70 and then that was a good deal. And it's overwhelming to you. But if you just know that it's going to go up and it's going to go down, relieve some of the fear that you're having. And this fear that you're having, you could equate that to a roller coaster ride. So the stock market really is just a roller coaster ride that you know there's going to be a start and an end to it, and that ride for you is going to be your life from when you start investing in the stock market until you get out of it, which what you want to do is for that to be into retirement and then on to build a legacy for your family. So a roller coaster, if you think of this, has tons of twists and turns, but it also has some straightaways. It's got ups and downs, it's got loops. The stock market's the same. You might be invested in one stock that's flat for 6 months. You're on the straightaway of the roller coaster. Price isn't fluctuating. Doesn't matter where you buy in. You're getting the same price. Then it might make a turn and it goes up. Well, that's great for what you've bought in. Now you're making money. But the key here is, if you're buying into the stock market, you want to go ahead and continue to buy that even on the way up. You're getting good value because in the long term, we know the stock market is going to go up in value, because we've seen our historical rates of return are always increasing. Now, it doesn't guarantee it for the future, but we know that there is a positive that goes along with this. And so you will buy as you go up, then you might come down on a big roller coaster ride. Well, guess what? That's okay. Now it means the market's on a discount. So now we're going to buy. But guess what? You've been buying the whole time. And you don't want to sit here and necessarily buy more at one value and more at another value and try to time the market. That's not going to work out. It's not some get-rich-quick scheme that you're going for here. We're building a long retirement road. We want to have our good portfolio built, and we want to buy consistent time over time over time. So this buying time and time again is called dollar cost averaging. And so what we're doing here is, over the course of time, we know that we want to buy a certain amount of stock every single month. And so let me give you an example. So if you were to buy, let's say you had $4,000 that you wanted to invest in the stock market, and you know that you want to buy, let's say you're going to go and you're going to buy some Tesla stock. Well, you could go out and you could buy $4,000 worth of Tesla stock today. Well, that would be okay. Or what you could do is you could say, I'm going to buy $1,000 of Tesla stock every single month for the next 4 months. And now what this is going to allow you to do is it's going to allow you to ride some of that roller coaster. So Tesla could be at a low point right now. Buy your 1,000, it might go up. You would buy another 1,000, would come back down maybe as it's got some volatility with it. Buy another 1,000, and the next thing you know, you've got your $4,000 invested and you're set to go. Now, I know that's on a microcosm that you're looking at, and you could say, well, okay, over 4 months, what if I bought it at a high point and bought it another high, another high, another high, and then all of a sudden it drops and it crashes? That, again, that's going to happen. You don't know what's going to happen, but the key here would be you're always investing. So if you extrapolate to the 4 month and you say, okay, I'm buying consistently, then you're probably not going to buy $1,000 of Tesla stock every single month. But if you were to buy an index fund, let's say, every single month, and you put in $1,000 into your retirement, and you just bought the S&P 500 index fund over and over and over and over, it doesn't matter what the price is, because over the course of time, we're talking years, decades worth of time between now and when you get to retirement, that is going to be a dollar cost average, and over the course of time you're going to see an increase. And so you might have purchased that S&P 500 at a lower cost compared to where you are at the end, and ultimately you're going to make gains on this. And that is really the key with the compound interest, where over time we start to see that money coming in and coming in and coming in. But the trouble with this, if you're not following this dollar cost average and just throwing money into the market every single month consistently regardless of what it's doing, then you start to try to time the market. And timing the market is not going to work out. You're going to end up becoming more broke than where you were. You're not going to be getting rich. You might hear some stories of people getting lucky, but really, if you're timing the market, you're gambling, and that's not something you want to do. And that's just not going to set you up for success in the future. Let me give you a few examples of how timing the market just isn't going to work for you. So if you look back into September 2001, right before we had 9/11, the stock market was looking really good and people were investing, and then all of a sudden 9/11 happened and the stock market plummeted. People didn't know what was going on, how this was going to affect the economy, and what exactly they should do. People started pulling the money out. And actually they had to go ahead and shut down the market for a couple days, try to get people to cool off. But then when they reopened, people just kept selling. So we saw this huge dip. Well, then just a couple months later, after 2001 in September, boom, stock market goes back up to the same levels that it was pre-9/11. So again, just shows you don't want to hop off the roller coaster. You don't want to let these external factors influence it. I'll give you another example. If you look at the 2008 housing market crash, well, that impacted our stock market and the financials that went with it. And we saw a huge dip in your 401k, practically 50% drops in some cases. But it took a couple of years, but the market did recover and is soared past all of those levels. So again, if you thought about this and you were thinking big picture, next thing you're going to know, this looks like a discount. You're like, woo, everything's half off. Let's buy. And then you're golden. So now all of a sudden these recessions you see are actually positives in your life. And one more example would be the current coronavirus that we had. Obviously, back in March of 2020, we saw this dip in the market, and people were like, oh, what is going on? Now, the government stepped in and did start to give us some stimulus to help with the economy. I think we're still in a little bit of a questionable area as to whether or not it's actually showing real values. But if you look at it, we saw a dip and then boop, back up, and now we're seeing record highs when we're closing. And so those three examples, they're just, it shows you just a microcosm of what's going on. And so if you zoomed in to right before 9/11 and as it was happening, you would say, oh my God, this is awful. Why would I ever go in the stock market? And then if you look shortly thereafter, you're like, well, yeah, let's go. This is a great curve. So you can't look at these small pieces. You have to step back and look at the stock market as a whole. And so that's where you look at these rates of return. So yeah, you want to look at a 1-year rate of return, a 5-year, but really what you want to look at is overall, how is it returning over the course of the lifetime of that stock? And that really gives you a good understanding for the stock market, those specific stocks, the mutual funds, and we'll dive into some of that on this channel later as to, single stocks, bonds, mutual funds, what you should buy, what your portfolio should look like. But really with this video, I just wanted to take a moment, step back, and just try to demystify some of the stuff with the stock market, give a little bit of confidence, and really just try to inspire you to learn a little bit more before just making the statement of, I'm not investing in the stock market, I'm going to close my eyes, I'm not going to look, it's just not going to happen. Just take a moment, open your eyes, look, see what's going on there, and try to understand. Just as with anything else in life, you got to take a moment, do a little bit of research, do some learning, watch some videos hopefully on this channel, and learn and understand what you're getting your money into, and think long term how and where you want to set yourself up for success later in your life. And so with that, guys, I really hope you enjoyed the video. I appreciate you being here. And if you don't mind, please go ahead, subscribe, hit that notification bell and that like button if you haven't done so already so you don't miss a video from me. Let me know down in the comments section if there's any topics you all would like me to cover in the future. And until next time, remember to think, dream, and believe in yourself. You got this.